The next topic in the first unit is sources of finance, or it is also called as sources of capital. You may be having an idea where these sources of capital for any company, for running a company, for you will be utilizing. So these sources, you can divide them into different types based on time period. If you take into consideration time period, we can divide them into long-term sources and short-term sources, medium-term sources, like that. So this how this is taken, that whether it comes under long-term or short-term or medium-term is by taking into the number of years. If any period that is less than 1 year period, 0 days to 1 year period, that comes under the short-term finance. And from 1 year to 5 years period is treated as what? Medium-term finance. And more than 5 years period, we are going to utilize any source, or any of them are going to allow you capital that comes under the long-term sources. So this is how we can divide them into different types based on time period taking into consideration. So we can have different sources in long-term finance. What are they? Sources means here from where the amount is going to be gathered. Okay. So one source you can utilize here is issue of shares. By issuing your company's shares to the public, you can get the amount. How this is, we will go in detail. Let us see what is the list. And the issue of debentures. By issuing debentures like bonds, that amount is going to be collected from the investors. So by issuing the debentures, which are called as bonds. And you can also get the amount from financial institutions. Some of the financial institutions are available, which are going to provide you loans other than banks, like ICICI, IDBI, like that, etc. You can take into consideration, which are going to give for special purposes. They are going to provide you the capital, which may be coming under long-term sources. These are going to provide you most probably long-term capital. And the other source you can take into consideration into long-term is retained profits. Retained means nothing but profits which are going to be earned. The full amount they are not going to utilize, are not going to distribute among the shareholders or whoever is the investors of the company. Some part of the profits will be kept aside for future utilization. So which comes under the retained profits. Retaining means keeping aside some part of the profits. So this keeping aside certain profits will be utilized as whenever uncertainty or whenever sudden contingency funds are required. Contingency means suddenly if anything happens unknowingly, you require certain amount. No? So that for that purposes, these retained profits will be utilized. We can take this COVID as one which is uncertain, which anyone has not expected. Suddenly it occurred. Some of the amount they require to overcome this uncertainty. Sudden lockdown laid the companies into losses. No? So in such cases, if they want the amount, they cannot get immediately. So if they are having a side kept, if they are having the retained profits, that can be utilized by the company to cover their expenditures in such conditions. So for that purposes, what these people are going to do is they will keep a part of a percentage of profit as a retained profits. So this is also going to be utilized for long-term purposes. Not only certain these conditions, in case if they want to expand the company also, they are going to use this retained profit. And the other one, it is public deposits. They are going to collect the public deposits also. Like these public deposits, you can get by issuing the debentures also. Okay. And the short-term sources, we can divide them into different types again. So one, it is trade credit. Trade credit means like any creditor that who are going to allow certain credit to the company in purchasing the raw material like that. No? They will allow you credit. Credit means nothing but the time period that for which they want to pay amount. Suddenly they need not pay the cash amount. A certain time will be given to them. They will allow certain 1 month or 2 months time period to pay back the amount for purchasing the raw material or etc. whatever they are going to purchase. So this will be for short period only, 1 month or 2 months or within 1 year this will be taking place. And banks are also going to allow you loans, advances, and short-term loans from many finance companies. Finance companies nowadays, you can see so many finance companies came into existence. So they are also going to allow certain short-term loans. Short-term loans means within the 1 year period, they have to pay back the amount. So let us see in detail how these are going to be utilized here. So issue of shares may be that may be divided into two different types. One, it is issue of equity shares, and the other one, it is preference shares. So equity shares and preference shares are differing. So how these are differing, that we have to discuss in detail. So what are the preferences that are given in case of equity shares, and what are the different preferences that was given to the preference shares. So in case of issue of equity shares, here the amount will be raised from the public. And what issue of shares means, here share is nothing but a part of capital that was divided, and that will part will be raised from the public by issuing the shares. So all these units, the division, for example, 1 lakh is there, that will be divided into different parts. Maybe let us say that each part consisting of value of 100 rupees means how many shares? Maybe 1 lakh divided by 100 means nearly 10,000 shares will be there, right? So if they are going to issue 10,000 shares, then automatically they can use 1 lakh. So like that, depending on the amount the company requires, they will divide the total amount into shares based on the value they are going to prefer to get from the. So all these units which you are going to divide will be having equal value. So no difference will be there from one unit to the other end, one share to the other share. Okay, this is how they are going to divide. And these are going to be issued to the public, and any public or investor can come forward and they can invest in these companies. So this may be done by issue of a prospectus. While discussing about the prospectus, we have discussed this. So they will be giving each and every information that is related with the company, even what is the position of financial position of the company is. So those who want to subscribe for this share capital, they can subscribe them. So once they became, once they hold the shares of that particular company, they are called as what? Shareholders. After purchasing the shares of a company, they will become shareholders. Before purchasing, they are called as what? Investors. Investors are different and shareholders are different. Investors means those who are ready to purchase shares. Shareholders means the persons, those who have already invested in the company. are named as what? Shareholders. That means they are holding the shares of the company, who are called as what? Shareholders. So these people, once they are going to purchase the equity shares, they will become the members of the company. Not only equity shares, even they can purchase the preference shares. Based on the necessity, the company will be issuing these things. Whether they want to issue the equity shares or preference shares, that will be decided by the company, not by the investor. So once they have issued equity shares, then those who are going to invest in these equity shares will become the owners of the company. If the company is going to issue the preference shares, the holders of the preference shares will be the members of the company, but they are not going to become the owners of the company. This is the main difference that you have to keep in mind. Who are going to hold the equity shares will become the owners of the company. Who are holding the preference shares, they are the members, only the members of the company. They are not the owners of the company. So why this difference is given means preference shares will be claiming dividend. Dividend means like a fixed rate of interest, like that you will be getting on this fixed deposits. Like that, companies will be deciding certain percentage of dividend will be paid to the preference shareholders. So this dividend, how this company is going to decide is based on their earnings. Earnings means profits. Profits, how much profit they have earned, based on that, the company management will decide what is the percentage of dividend they have to pay for the preference shareholder. It is not compulsory that they have to pay the dividend. Different types of, again in this preference shares, we are going to come across different types of preference shares. What are they? We will discuss now in the later. But why these shares are called as preference means when the company is going to earn profits, first the preference will be given to pay the dividend to the preference share. Preference, right? Preference means preference will be given, importance will be given to pay the dividend from the profits to these shareholders. That is the reason why it is named as preference shares. And after once these people are and all the preference shareholders are paid the dividend, if still profit is left over, then only that profit will be distributed to the equity share. Because they are the owners, the leftover profits will be distributed among them. After once retained retained profit is kept as and still profit is there means then that will be from that creditors will be paid first. Creditors means like any supplier they are going to give certain raw material, etc. All those creditors will be paid first, and still profits are left over. Then first preference will be given to preference shareholder, and then again if some more profits are there, then that will be distributed among the equity shareholders because they are the owners. And it is not legally compulsory that payment of dividend is needed. Compulsory pay cheyalani emi ledu. But this will be given in the this information whether they are going to pay the dividend or not. That will be given by issuing the preference shares. I mean, what is the type of that preference share? Based on that, decision will be included there. Some rights are there for preference shareholders, as we have said that they are having they can claim the repayment of capital while winding up on the company. Winding up means while closing the company also, these people will be given first preference. Okay. And if they are not having, if the company is not having profits, then after selling of the assets which are lying with the company, amount will be paid to the preference share capital, preference shareholders. And how this is paid means any loans they are going to take from any financial institutions, banks, all those amounts will be paid back till if the amount is left over from the sale of the assets. The leftover amount will be given preference to pay back the preference share capital. That is the reason why people won't come forward to hold these shares. So you have to keep in mind that when you come across the shares means shareholders will be given last preference after the bankers, financial institutions, any creditors who has given them any credit. So after meeting all these people's amount only, then from the leftover amount, first preference will be given to the preference share. That is what you have to keep in mind. You don't think that preference shareholders means they will be given first preference, leaving all these people. After paying all these people only, preference will be given to the shareholders. Among the shareholders, first preference will be given to the preference shareholders. And then it will go to the equity shareholder. This is the main important point you have to keep in mind. So these people are going to have certain privileges than the equity shareholder. So they are not going to directly take part in any matter of the management. So whenever any general meeting is conducted, there they cannot directly take part. And they are not going to be given any voting rights also. So while electing the directors, shareholders will be having the rights, but only the equity shareholders will be having the right, not the preference shareholders. So we can divide this preference shares into different types. While issuing only, they will be giving that information that what are the different types of which type of preference shares they are issuing. So one it is cumulative or non-cumulative, participating or non-participating, redeemable or non-redeemable. That means here 6 types we are going to come across: cumulative, non-cumulative, participating, non-participating, redeemable, non-redeemable, and convertible, non-convertible. So all these are the different types of preference shares. So what each type is related with. In case of cumulative preference shares, cumulative means nothing but adding up, right? So what is going to be added up means here, always the company may not be earning the profits, or sometimes they are not going to declare the dividend. In any one of the year, if the company is not going to issue the dividend due to any reason, so that amount of dividend will be added to the next year, which is called as what? Cumulative preference. So that means whatever the previous year's dividend is there, that will be added to the present year, and that will be issued to the preference shareholder in terms of dividend. So cumulative preference means that is the meaning, adding previous dividend to the present dividend. And in case of non-cumulative preference shares, they are not going to pay like that. They are not going to add the previous year's dividends. In case if any company is going to be in losses in 1 year, what happens? They are not going to pay dividend in that year. No? So in the next year, if they are going to earn profits, in such case, they are not going to add previous year's dividend in case of non-cumulative preference. So this is what you have to identify whether it is the company is issuing cumulative preference shares or non-cumulative preference shares while investing your amount in the company. And participatory shareholders. So they are these people are going to be sharing in the surplus profits. After reasonable dividend is paid to them and to the equity shareholders, if still some more profits are there, surplus means excess profits are there. So in such cases, participatory shareholders will be given importance. Again, they will be paid dividends. Non-participatory means such a right won't be there for them. Only they will be earning the dividend. In surplus or profit, they are not going to get any whichever share for non-participating preference share. And another type is redeemable preference share. Redeeming means not getting back. So these shares, preference shares, will be for long-term period. We said no. So once it is deposited, they cannot get back if it is irredeemable. But after a specified period, these redeemable preference shares can be withdrawn by the investor. For example, after 1 year, if the company has issued the preference shares, means after 1 year they are going to allow the shareholders to get back their amount, withdraw their capital. Means such a type is called as what? Redeemable preference shares. If they are not going to allow the preference shareholders to get back their capital, so in such case it is called as what? Irredeemable preference shares. So sometimes the company itself is going to purchase the shares. So in such case, they are going to give a certain notice and they are going to redeem these shares. And convertible and non-convertible means here, if in case if you feel that the company is earning more profits and you have not purchased the equity share, so in such a case, what these convertible preference shares is having the right to convert their preference shares into the equity shares. Okay, once they are going to be converted into equity shares, they will have the rights, all the rights that are related with the equity shareholder. So such preference shares are called as convertible preference shares. What is it? What is it? Mute yourself. Any doubt? Okay, like that, if you are going to, if you prefer to convert into equity shares, you can convert them. Non-convertible means even though if you prefer to convert into equity shares, the company will not allow you to convert your preference shares into equity shares. Okay, so these are the different types of preference shares that we come across in the any company. By issuing the company, issuing the shares itself, the company is going to specify which type of preference share they are issuing. You must be very careful while investing. What is the type of preference share they are issuing? So why these companies prefer to issue this preference shares means due to certain advantages are there. At the same time, it is also having certain disadvantages also. What are they that we will see in detail now. So the company is going to prefer these preference shares because it is having certain advantages. One, it helps to increase their sources of funds. And not only that, immediately you cannot get from a financial institution or a banker to get the loan from them. You need to follow certain procedure, lengthy process. It will take time. Issuing this shares will be giving you advantage of gathering the amount as early as possible. You don't have any restrictions, no? Within 30 days or 40 days after issuing the shares, public will come forward and it will be very easy to get the amount from the public, right? So that to increase your sources of funds, this will help you. That is one reason why these people will prefer preference shares. So that means for issuing of equity shares, there will be a limit. After that, they cannot issue the equity shares. So in such cases also they can prefer the preference shares, issue of a preference shares. So in this preference shares, most of the financial institutions will come forward nowadays. Even bankers are coming forward to invest their amount, large amount they are going to invest in these shares. So even individuals are coming forward to hold these preference shares. So that means immediately company will be getting the share amount, capital amount, funds. Why these people will come forward to invest in the preference shares means they will be giving you a fixed rate of dividend. Fixed rate of dividend will be issued by these people, companies. So automatically every individual or financial institution will come forward to invest their amount. And they are going to pay only when there is, even though they have given you fixed rate of, for example, 10% or 8% or 5% of dividend they are going to pay. So that will be paid only when they are going to earn profits only. This is an advantage to the company. If the company is not going to earn profits, they need not pay the dividend based on the type of the preference share. Okay? That will be an advantage. No? So automatically, company prefers to issue these preference shares. And these people are not having the right to involve in the management aspects. So that is also one of the advantages to these companies. Like equity shareholders, they are not going to involve in any election of directors or in any general meeting. They are not going to be involved directly. So that will give the company to control over their management. That means these preference shareholders will not affect their management. So that will be another advantage to the companies. Why these shares are going to be issued? So these are the advantages when a company issues the preference shares. So at the same time, we have certain disadvantages also for it by issuing these preference shares. What are they? Let us see. They have to pay dividend. So, for example, if they are not going to, if they are going to issue cumulative different transactions, they cannot avoid paying the dividend to the different shareholders. So these dividends, whatever they are going to pay, they are not going to be included in the expenses. While preparing the profit and loss account, we are not going to include these dividends to preference shareholder in the expenses column. So which will show you that it is profits are more. Profits are more. Net profit will be shown more. So due to which what happens if profits are more, taxes should be paid more. The tax saving will not be there. If you are going to get the loans from the bank, because you will be paying interest to the bankers, no? That interest can be included in the expenses. But whereas dividends on different shares will not be included. So this is a disadvantage is that. That means tax saving is one of the disadvantages. No tax saving is there to the company. In case of cumulative preference shares, you need to pay the company need to pay the previous year's dividends also, even though it is not compulsory, legally compulsory. The disadvantage is that. So most of the investors will not be attracted to the preference shares because they are having the disadvantage of type of preference shares will be making the investors to go away from the investment in preference shares. If they some of the if the profits of the company is going to be less, in such case they are not going to be paying the dividend. That may make the investors to not to invest in this preferential shares. So all those are the disadvantages of preferential shares. And coming to the importance of equity shares, here by holding these equity shares, there are certain advantages and also disadvantages. Before which, what are the rights they are having, that will be see. In case if you are going to hold the equity share, they are not going to be given a promise of certain fixed dividend, of course, but still people will come forward to invest in these equity shares. Why? Because if the levels of profit is very high, in such case, these equity shareholders, whatever the leftover profits are there, all the profits will be enjoyed by them. By investing a little amount, they will be enjoying large quantity of large percentage of profit returns. So that is one thing which is the advantage of this equity shareholder. So this will automatically attract the investors to come forward and invest in this profits. Sorry, in this equity shares. In case of losses, they have to bear the loss. They won't get any profit. They don't get any returns. If the loss is more, automatically this will be a big loss to the equity shareholders. But they will be enjoying control over the management because they are involved in any of the general meetings. They are going to have voting rights. So automatically they will have a control over the management. And they coming to their liability. Liability will be limited to the extent of the share they have holding. For example, as a shareholder, I am having 10,000 rupees of shares in the company, means my liability will be limited to only 10,000 rupees, not more than that. That, that also makes the investors to come forward because of limited liability. People will come forward to invest in the shares, and they are going to enjoy more profits, no? So more returns from the investment. When we come in detail about the merits and demerits, you can say what is the merit. They will be the owners. They are going to get more profits, returns. That means that while investing itself, you have to see whether the company is a profitable business or not. When you invest in the equity share, if they are going to be earning more profits, then you will be getting more returns. So, but that people will invest in equity share when the business is running more profit. Even some people will borrow funds from outside and invest in these shares. But don't do like that. So whenever you have your own capital with you, then only you come forward to invest in the equity shares or venture shares. Because this may be sometimes it may be earning you dividends, and sometimes it may not earn dividends or returns. So why companies will issue equity shares means they are not they are going to get this amount in terms of equity shares at a lower, not only lower, you cannot say. If profits are earned, then only they are going to pay the return. So without any paying back the return, they can borrow the funds from the investors. And if they are going to get loans from outsiders or bankers or financial institutions, they will be compulsory charging for the rate of interest which they need to pay to them, even though they are not going to earn profits of that. So that is the reason why companies will prefer issuing these equity shares. So here merits and demerits means don't think in terms of the investor. Think in terms of company. What are the advantages and what are the disadvantages? And they are going to, there is a tax saving. Interest can be paid to the, in terms of loans to the government. That will be a tax saving to the company. So even if the company is going to issue the dividend, they are not going to get the tax saving. And assets are not required to give any security. Whenever you are going to raise equity shares, you need not give them any collateral assets. Collateral assets and like they cannot, they need not show any, these many assets are there in the company. We are going to give you security to your share capital. Like they are not going to give any assurance to the investors. So because of that, we are going to raise the equity share capital. At the same time, the company will be having certain disadvantages if they are going to issue the equity shares. What are the disadvantages when they are going to issue the equity share? So whenever there is fluctuation in the profits due to changes in the environment or in the market, so in such a case, will the investors come forward to invest in the particular company? No. So that will be uh, very difficult in such cases. They cannot raise funds from the by issuing the equity shares. that will be disadvantage to the company. So in such conditions, they cannot get the capital in the public, because the investors are also too intelligent that they will look after whether the company is earning profits or not, and they will look up the previous conditions of the company before investing the amount itself. That will be very difficult to the company to raise equity share capital in case of changes in the returns of that company. That will be a risk to the company. So even in the market conditions changes, in such case also, like COVID, nowadays people are preferring, instead of investing in the shares, preferring to invest in the gold, silver. That is the reason why the gold rate is going up, silver rate is going up. Right? That means at this time, investors are not preferring to invest in the company shares. Instead of that, they are preferring to invest in the gold, silver, assets, commodity, because they are going to earn more return from those assets, commodities. In such cases, it will be very difficult to companies to get the capital by issuing shares. And another source of long-term capital is the issue of debentures. How we can say the issue of debentures will be a long-term source means here. These issue of debentures are also going to be raising loans from the public. Instead of issuing shares, they are going to raise loans from the public by issuing the bonds, like fixed deposits. They will be issuing one bond to the debenture holder, in which each and every information will be given, like what is the amount they have issued in terms of bond, and what is the time period, and how many number of debentures they are holding. All those will be included in this certificate, or we can also call it as instrument or bond. So this will be acknowledged by the company that it is a debt. Do you know what is the mortgage issue when it was long back? It has happened. They have issued more than what they are having right. They have issued this more debentures. They have collected more debentures. I think we people maybe very 5-6 years old at that time. So what happened? Bangladesh has issued these debentures. They will be having certain limit to issue the bonds. More than that limit, they have issued debentures to the public, and they have collected amount in terms of debentures. At that time, it became a very big issue, because the company, according to Companies Act, action will be taken. That is how it went in a big uncertainty in that time. So those who are going to hold these debentures are called as debenture holders. As shares, if you hold shares, shareholders. If you hold debentures, debenture holders. So these people will be the creditors of the company. Why creditors? Means they need compulsory, they have to pay the amount to the debenture holders. Even profits are earned or not, that amount should be paid to these debentures. Compulsory, whatever the dividend that was fixed on this debenture, that should be paid to the debenture holders. So these debentures will be issued in multiples of 10, or 100 or 500 or 1000. No. Okay. That means 1500, 2000 like that. 1000 ఉండొచ్చు లేదంటే 100 to 500 like that. So this will be carrying an fixed rate of interest. Interest here. Okay, not a dividend. Dividend and that will be paid from profits. Only when profits are earned, dividend will be paid. Interest means even profits, it is not related with profit. The rate of interest will be paid here. And not only that, even though fixed deposits are there, why will people will come forward to invest in the debentures means rate of interest will be more. Okay, time is up, I think. I will complete this slide and close. And these debentures should be paid after a certain period. 1 year period is after 1 year period, the debentures should be paid. 2 years period, 3 years period. What is the life of that particular bond? Based on that, that should be paid back. Any issue of the company is not going to be involved here. So everything will be given while issuing that bond itself. The terms and conditions will be given. So here also we will come across different types: secured, unsecured debentures. Secured means some assets will be shown as a security. Unsecured means without showing any security, debentures will be issued. Secured means this whenever a new company comes, investors, to attract the investors, they will show certain collateral assets to the debenture holders. Because they need security, they need without a security, investors will not invest in the debenture. Unsecured, when the company is existing and earning profits, in such cases, they need not gain the they need not attract the investors. Everyone will come forward to invest in the debentures. In such cases, unsecured debentures will be issued. Convertible or non-convertible. Convertible, converting into shares. Non-convertible means no such conversion will be there into shares. Only it will be debentures. Certain advantages, disadvantages are there. Let us see in the next class. I think this is enough for today because time is over. Any doubts in understanding this?